Question 4 dealt with estate planning. All right, estate planning, now if you think of the module and what it covered, we look at estate planning objectives and the estate planning tools or measurements that one can use to implement or rather achieve those objectives. Okay, so these type of questions are really more a discussion kind of question. We'll be asking things like, what are the objectives? How will one implement certain estate planning tools? Criticize existing estate plans or come up with estate plans. So it's really more advisory kind of questions where you act in an advisory capacity and discussion kinds of questions. All right, question 4 had 2 parts. It was a part A and a part B. All right. Again, roughly about half an hour is what you should be spending on this question. Okay, it counts 22 marks. If we deal just with part A firstly, part A was nice and quick. It was 10 marks, literally 10 minutes is what you should be spending on here. Okay, if we look at the required part, it looked at liquidity. Okay, now we know liquidity is one of the objectives that one can have in an estate plan. Okay, so we had to determine or estimate rather Sunita's current estate liquidity position, taking all the above information into account. All right, and then in part 2, we had to determine what cover Sunita would need if she took out an insurance policy, assuming there was a cash shortfall of 200,000 in her estate. All right. Okay, if we read the question now, Sunita is obviously the person in question. She is single, lives alone, and considers her 2 dogs, Jack and Russell, to be her only children. She would like to take out life insurance policy that would one day cover the estate duty that will become payable in her estate. She currently has the following assets and liabilities. Okay, and here we list all the assets and liabilities that she has. She has a home worth 3.1. She has a mortgage bond against that, quite a big mortgage bond of 1 million, just over 1 million. She has a holiday home of 2.7, a bit of cash, a credit card, a motor vehicle that's been paid off. She has a retirement annuity lump sum that is going to be payable to the estate. Okay, and then the estimated admin expenses when this estate needs to be wound up when she dies will be executors' fees and masters' fees and funeral costs and all of that, amounting more or less as estimated to 672,000 Rand. Sunita's will includes a cash legacy of 50,000 Rand to her sister, who must use the money to look after Sunita's 2 dogs. Okay, so we are required to look at the liquidity position. Now, liquidity looks purely at just the cash. What is the cash amount that Sunita currently has in her estate? So if you quickly glance at this, you can see it's not very liquid. All right, she's got a lot of assets and she's got a lot of liabilities which obviously need to be settled. So there isn't a lot of cash besides the cash in her bank account of 56,000 and this retirement annuity lump sum that will pay out to the estate on her death of 640. But that's hardly enough to cover this mortgage bond, some of her admin expenses and so forth. All right. So if we just quickly do the liquidity calc, part A. All right, we list just all the assets then, or rather all the cash. What is the cash amounts in this estate? Okay, the first cash amount is the cash in the bank of 56,000. The other cash amount would be the lump sum when it pays out, and that's the 640. The cash legacy is obviously going to have an impact also because there needs to be enough cash to be able to fulfill that condition of the will. So that amount of the legacy needs to come off here, and that's 50,000. All right. Her credit cards need to be paid off. And that's 42,000. Her mortgage bond. Okay, obviously with time, her mortgage bond will decrease. Okay, but we're looking for the current liquidity position. So the current mortgage bond at this stage is 1050. million. Okay, and then the admin expenses. Okay, so there is quite a big cash shortfall in Sunita's estate at this stage of 1.1 million, roughly. Okay, so she would need to take out life insurance cover of quite a big amount, okay, unless, which wasn't really required in the question, but just so that it gives you more background on how to deal with estate plans. She could also decide to sell some of her assets, and that obviously would provide some liquidity quite quickly in the estate. The second part of Part A then asked, calculate the amount of cover required should there have been a shortfall of only 200,000 Rand. Okay, and how you do this is you need enough of an insurance policy to cover the shortfall of 200, but also enough to cover estate duty. Okay, remember that the insurance policy that she will take out will be included in her estate, all right? So she will pay estate duty on that 200,000 now also. So she can't just take out the policy for 200,000. She needs to take out enough to still cover 20% on that insurance policy, the 20% being the estate duty. Okay, so this is simply just a maths calculation that you need to do. Okay, so this was 1 and this is 2. Okay, the amount of cash that is required, cash required, is 200,000. Okay, the estate duty rate currently is 20%. Okay, so if we take the 200,000 times by 100 divided by 80, that's going to give us 250,000 Rand. Okay, so she needs to take out cover for 250. If you do the proof, you will see that if you take 20% of 250, she has to pay estate duty of 50,000 Rand, which leaves her then with 200,000 Rand cover, which is exactly what she needed in order to cover her cash shortfall of 200,000. All right. Okay, so part A is done, very quick. You really don't need to spend a lot of time with that. Okay, part B then was where the discussion of the part of the question discussion was required. All right. So if we look at part B, there were 2 parts again. The required part, we had to discuss the main disadvantages of Mr. Dlamini's proposed plan. Okay, so we were looking here for basically the critique. You had to analyze a plan and just list and then discuss the main disadvantages. All right, we did not want you to address any recommendations or alternatives. Okay, so don't get into the habit of trying to fix the disadvantage. We just really wanted you to discuss the disadvantage. And this was for it was for 9 marks. So roughly in your head, you can say to yourself, okay, they're probably looking for about 4 disadvantages, and then I'm going to discuss each one and state why that it is a disadvantage. Okay, and that should more or less give you the 9 marks we're looking for. Part 2 was to discuss the tax consequences. Okay. Of Mr. Dlamini, were he to sell the commercial building to the trust instead of donating it. All right, so as we go through the question, you'll see now what it's all about. But here we were looking for tax consequences for about 3 marks. Okay, so there, not too much, we didn't really want a very long discussion there. Maybe just list 1 or 2 points and then the reason. Okay. If we look now at the question and read, again, about 15 minutes for this. Mr. Dlamini is 46 years of age, and he recently got divorced and has 2 children. His daughter and son are 14 and 19 years of old, respectively. Okay, so at this point, we have a minor in the picture. He tells you about what he thinks is a brilliant plan to save income tax and estate duty when he dies. Okay, so if you think of your estate planning module and what it's all about, Mr. Dlamini's objectives here were obviously to save income tax. All right. So I would just keep this in mind. So his objective really was to save taxes. Okay. This is what he proposes. I will donate a commercial building that I inherited from my late father to an inter vivos trust. Okay, so there's a lot going on there. He thinks he's going to donate the building to an inter vivos trust. All right, so you need to understand what an inter vivos trust is and what the implications of donating an asset to an inter vivos trust will be. What the implications will be, yeah. This trust will be established by me, the founder. All right, so Mr. Dlamini will be the founder and he'll be the only trustee. Okay, that should be a red flag. Okay, that is a problem. Okay, when going through your trust part of the module, you will know that it's never a good idea just to have one trustee, especially when it is the founder of the trust. Okay, it's usually a good idea to always have at least two trustees, so that the founder isn't really in control of the trust himself, and he has to always get the vote of two other people. Then my two children will be the only beneficiaries of the trust. Okay, that's fine, but he's not going to be a beneficiary of the trust, so that is a bit strange. And then the commercial building is currently valued at 9 million rand and generates rental income of 150,000 rand per month. Okay, so this building is very valuable, and the fact that he hasn't made himself a beneficiary and party to receiving any of this rental income could potentially be a concern, because it's definitely going to affect his livelihood. All right, I'm sure anyone will miss 150,000 rand a month. All right. For this part of the question, I'm not going to write out the answer. Okay, I'm just going to discuss the solution. You obviously have it in front of you, so I'll be getting it in front of me as well. So here we have to discuss the main disadvantages of this plan. Okay, so as I read the proposed plan Mr. Dlamini had, I highlighted certain things to you. The first disadvantage would be that he's going to miss out on 150,000 rand rental income a month. Okay, that is definitely going to affect his livelihood. He has not made himself a beneficiary of the trust. All right, so that is one disadvantage. Okay, so there it's point number one. He's no longer going to receive the rental income, and it's definitely going to affect his livelihood. Okay, and that's that. Don't go on and discuss, and you can see the marks are 9, only 9 marks. So you mustn't go on, and we don't want a whole page of discussions. All right, you need to stick to your time limit, remember. So state the disadvantage, and if it needs to be elaborate with another 1 or 2 points and move on. The second disadvantage is that he'll be donating the asset to the trust. Okay, by donating an asset to the trust, this has obviously donations tax implications, all right. And this is definitely not going to save Mr. Dlamini any tax, all right, because the donations tax that he will pay is 1.8 million on the value of the asset that's 9 million. Okay, donations tax is 20%, remember that. So by no means is he going to achieve his estate planning objective of saving tax, all right. So that's your point that you need to state. He's going to pay donations tax and roughly about 1.8 million, which is a very large sum of money and will not save him income tax. The next point is the rental income that will be distributed to the minor daughter. Okay, this is a problem because of there being a minor daughter in the story. The daughter and the son are the beneficiaries of the trust. So they will receive 150,000 rand distribution, rental distribution from the trust. Now, because the daughter is a minor, Mr. Dlamini is deemed to actually receive that income, and he will be taxed on that income that his daughter receives. Okay, so if he again thinks he's going to be saving tax, it's definitely not the case, because he'll now need to pay income tax on that amount distributable to the minor daughter. Okay, so again, state the fact that in terms of Section 7.3 of the Income Tax Act, he will need to pay income tax on that amount until his daughter turns obviously 18 years old. All right, which is then when she will start paying income tax in her own hands. Okay. And then the very last point of another disadvantage is Mr. Dlamini might fall foul of the provisions contained in Section 33D1 of the Estate Duty Act. Okay, so what this section of the Estate Duty Act says is basically, because he's the founder and the only trustee of the trust, and he basically just moves the asset from his name into the trust, means nothing. It's in effect as if that transaction hasn't happened and the commercial building is still in his hands. So when he dies, he's going to pay estate duty on that commercial building because it's going to be deemed to still be in his estate. All right. And that's purely because he made himself the only trustee. If he had appointed two other people, maybe his accountant or lawyer or somebody independent, then they have to all decide and be in agreement as what happens with that building. And then it would have obviously looked like he didn't have the sole control over the property. All right. So there were 3 points that you just needed to state. State the section that's the problem, that the deceased property would still be in his estate on his death, and obviously he would pay a very large amount of estate duty, because if that building is worth 9 million today and it increases in value, who knows what the value will be in a few years' time. So obviously his estate duty amount will be quite high. Okay, so those were the disadvantages of this amazing plan that Mr. Dlamini thought he had. All right. The second part of this question was then to discuss the tax consequences of Mr. Dlamini. If instead of donating the property, he would have sold it, yes, there definitely would have been some other tax consequences. Okay. Again, I'm not going to write out the answer. I'm just going to discuss it with you. Just to go back to part 1, if you had had another valid disadvantage of Mr. Dlamini's plan, we will obviously take it into consideration. All right, so if it's a valid disadvantage and you state a reason and it all makes very logical sense, we still will give you the marks. Okay. All right, back to part 2 of the question. Okay, if Mr. Dlamini had sold the building, all right, this definitely would have had a different setup for him. Okay, he would not have paid donations tax, so definitely saving up to 1.8 million rand. Okay, so that's definitely a saving of tax. So remember, it's the tax consequences we're after. So the first tax consequence would be no donations tax. And the other tax consequence is that he wouldn't pay income tax on the amount that would be distributable to his daughter. So the Section 7(3) of the Income Tax Act, which deemed him to receive that income and pay income tax on the 150,000 rand distributable to the 2 children, would not apply now. And that's it. I think we've done question 4 and we've dealt with estate planning.